GameStop stock is down almost 85% in the past 5 years, and the stock crashed by over 35% in a single day last week after they announced earnings and they cut their dividend, which by the way was yielding around 20% at that time. But you may have also noticed that the stock popped by over 8% yesterday and climbed another 5% today. So what the heck is going on with this stock? Was the dividend cut worth it, and now management is focused on turning the business around, making this a great buying opportunity for the stock? Or is all hope lost and GameStop is ultimately doomed to fail? Well, in today's video, I'm going to share my opinion on all of that and a lot more. Let's get started. What's up everybody, my name is Ale and welcome to my world of stocks. Now you guys know GameStop. They are mostly a video game retail company. They mostly sell new and used video games at physical brick and mortar locations, but they also sell video game consoles, accessories, collectibles, all kinds of different knickknacks and different things like that. But when looking at their success in the past, that was mostly tied to the sale of used video games at their brick and mortar locations. But times are changing. Digital video games have become more popular, which is translated to lower physical video game sales, which means there's less physical video game copies out there in the wild that GameStop can persuade you to sell to them, and then they turn around and sell it at a much higher price, at a much higher margin to somebody else. And this whole kind of snowball effect of higher digital sales and lower physical sales has had a devastating impact on GameStop sales and their stock price. So let's start there. Now you might remember an old video that I made about a year ago about GameStop stock with a sarcastic title that wrote, "Let's all buy GameStop stock because it has a 10% dividend yield." And that was a joke title because at that time, a lot of people were saying that it was a great value stock with a great dividend. But I argued that sales were very weak, there was no growth in sight, and that dividend would not be sustainable if management didn't turn things around, so I myself refused to buy the stock. Well, at that time, GameStop was trading at close to $15 a share, but today it's trading at less than $6 a share, which is a drop of over 65% since making that video. And just in 2019 alone, the stock is already down almost 55% year to date. And I'm not saying that to be cocky. As a gamer myself, I actually want physical game sales to be relevant, and I want actual video game stores to remain in existence. But for GameStop, it's just not a realistic business model to center your entire company around, and therefore both sales and profits have been taking a hit as a result. Here's a chart of their sales for the past 4 years, and you can see that the results have been relatively flat at best. That weak performance has had an even bigger impact on their profits, as they pretty much started to deteriorate in 2015, crashing from over $400 million of net income to an actual loss of almost $700 million last year. To be fair, there were some massive goodwill write-offs last year, but that still ultimately shows that their business isn't worth nearly as much as it used to be, and profitability going forward, at least from a GAAP net income perspective, is going to be something to at least keep an eye on. Now, if we dig a little deeper, we can see that their sales separated into the past 8 quarters have also had little to no growth, and if we convert these numbers into year-over-year figures, we can see that 3 of the past 4 quarters have actually had negative growth by some pretty large amounts, with this latest quarter seeing a drop in sales of over 13% year-over-year. Speaking of which, we might as well dive deeper into those Q1 earnings, since that was when they decided to cut their large dividend just about a week ago that sent the stock crashing by over 35% in a single day. Okay, now they actually beat EPS estimates of -3 cents, coming in at +7 cents, but sales were a different story as they reported $1.55 billion versus $1.64 billion expected. And again, this was a year-over-year drop in sales of over 13%, with same-store sales still dropping by over 10%. By the way, this article doesn't show their year-over-year drop in profits, but GAAP net income fell by a massive 75%, and you can see that in the span of 2 years, half of the quarters have been in red, with the other half barely making it into positive territory. As a result, GameStop has finally decided to abandon their dividend that was enormous in relation to the stock price. Right before the announcement, their dividend yield was hovering around the 20% mark, but like many good things in life, the high yield was too good to be true, and they announced that they are now cutting the dividend entirely in an effort to save over $150 million a year as they focus more heavily on remaining profitable and reducing their debt. By the way, their balance sheet isn't that bad to begin with, as their current assets cover all of their current and long-term debt, but as profitability shrinks, the balance sheet becomes more important, so I can see why they're focused more heavily on it. In any case, soon after the announcements, the stock proceeded to crash by over 35% in a single day. This now leaves the stock with a price to sales ratio of only 0.07, a price to book ratio of only 0.43, and while their trailing price to earnings ratio is not available due to negative earnings, apparently Wall Street still expects them to be profitable next year since they give them a forward PE ratio of less than 4. However, when factoring in future growth for the next 5 years, their PEG ratio actually turns negative, as we can see here that earnings are expected to drop by over 37% during that time. And if we add sales estimates into our revenue chart, we can also see that they are expected to continue dropping in the next couple of years by 8.4% and 2.6% respectively. So overall, it looks like GameStop's best case scenario is for their business performance to probably remain relatively flat, but more realistically, it looks like it'll probably continue this sort of downward trend, unless their management can actually turn things around. So what kind of changes are they implementing to do just that? Well, let's take a look. Well, for starters, you may have noticed when I showed you the stock charts earlier that their price actually jumped up by over 8% yesterday and almost 5% today. And the reason for that is because they announced a Dutch auction, which to be honest, I'm not very familiar with myself, but apparently it will entail buying back up to 12 million shares in the price range of $5.20 to as much as $6, which explains why the stock shot up but is still under that $6 mark. In any case, 12 million shares would equate to almost 12% of all outstanding shares, and that could also help their EPS numbers in the future and give them a better looking PE ratio. And seeing as how their dividend cut is supposed to save them almost $160 million this year, one would assume that the company can afford to make this move. Not to mention that if management actually turns things around, then buying back the stock at these lower prices is probably the smart thing to do, but again, that's a big if. When commenting on the decision, their newest CEO, George Sherman, basically said that while they improve their operations and focus on returning value to shareholders, the purchase of these shares makes financial sense at this time, and they will continue to focus on implementing long-term growth initiatives. By the way, I believe that this is the fourth CEO for GameStop in a little over a year, so it's been a difficult position to fill. In any case, this new CEO believes that he has the experience to implement large, successful transformations, and the company's newest plan, dubbed GameStop 2.0, looks like it will focus on implementing a cultural experience into their gaming retail stores by transforming them into gaming environments with televisions set up for testing video games rather than just seeing posters all over the walls, in a move to encourage gamers visiting the stores to not only buy new video games, but also be encouraged to trade theirs in and purchase other used video games as well. I personally think that this is a losing formula, but I'll explain why in just a second. First, I want to look at their segments last year, and you can see that their three biggest segments that make up over 70% of their revenue were hardware sales, which is pretty much consoles like the Xbox, PlayStation, and the Nintendo Switch, and then new video game sales, and finally used video game sales. And every single one of those segments saw a drop in sales year over year. Yes, they did have success in the other three segments, but again, those make up less than 30% of the revenue and mostly involve sales of gaming accessories and collectibles. And I'm not sure you can build an entire business with close to 6,000 retail stores selling just knickknacks and gaming related accessories and toys and things like that. I would imagine that if that was your main focus, you'd probably be better off selling them online with much higher margins and not have to be wasting money on 6,000 stores and all of the employees that go along with it. By the way, they've already closed over 130 stores in 2017 and another 58 stores in the first 3 quarters of last year. Now, to be clear, I'm not a fan of retail stores disappearing and everything moving to online shopping, but that's just the reality of the situation. Not only does e-commerce continue to steal market share away from traditional retail, as you can see on this chart here, but according to Statista, physical video game sales have been getting destroyed by the rise of digital gaming. Granted, this chart also includes computer games, which are pretty much always digital, but just comparing the percentages to what they used to be only a decade ago is extremely telling of where the industry is probably headed in the future. So for me personally, when I look at a stock like GameStop that is down almost 85% in the past 5 years, still brings in billions of dollars in revenue every single year, and they're expected to be profitable next year with a forward PE ratio of less than 4, and I think, there might actually be some value here. But then I think about where the industry is headed in the future, and I just think there's no way that I could ever invest in a company like this. Even with their most drastic changes that they're thinking about doing, they're still focused on bringing customers into their brick and mortar stores, selling them new physical video games, convincing them to sell back to GameStop their used physical video games, and then sell other people used physical video games. And with the rise of digital gaming, there's just no way that that business model makes sense to me. When you look at what Google is doing with Project Stadia, which is basically streaming video games, and then you look at Microsoft, they have Games Pass, which is pretty much like Netflix. So you pay a subscription fee, and then you play a catalog. You can play a catalog of different video games, but it's all digital. And you look at something like EA, they also have EA Access. It's a very similar thing to Microsoft Game Pass. And Microsoft is also doing Project X Cloud, where they will be streaming video games to your cell phone, to tablets, to computers, all through the Microsoft Azure cloud platform. And I just think that there is virtually no growth out there for physical video game sales. I'm not saying that I want physical video games to disappear. I'm actually a huge gamer myself, and I love to collect physical video games, and I love the idea of there being video game retail stores, brick and mortar stores that I can go to, but it's just not the reality of the situation. The future is really digital, and that's where the growth is going to be. So can GameStop still kind of hang around for another, I don't know, few years or maybe even a decade or so? I don't know, maybe, but there's not going to be much growth there, at least in my opinion. All the growth is going to be on the digital side. So best case scenario is, again, their business remains relatively flat, and I just don't even see that happening. I see growth in digital, and that growth has to come from somewhere. It's going to be stealing market share from physical video game sales. And in reality, the only companies that I think are doing physical video game sales correctly is something like Best Buy or Amazon, both of which sell their video games at much cheaper prices than what GameStop sells them. I never shop at GameStop myself because I can always get cheaper prices at Best Buy and at Amazon, and it's because they sell other products, so they can afford to take a loss on some of their video game sales because they'll get you to buy other products. But GameStop, they can't really do that. All the other products that they have is mostly knickknacks and collectibles and accessories, all things that you can buy online for probably a lot cheaper. And even when you look at their plan of putting in a bunch of video game consoles and TVs and making a whole kind of gamer environment, which by the way sounds awesome to me. Again, as a gamer myself, I would love to go and hang out at a gaming place and maybe do like little tournaments and things like that. But there's another huge problem. GameStop stores, have you ever been to one? They're incredibly small. How the heck are you gonna fit a bunch of gamers into these like little tiny stores? I just don't think it's realistic. So if they really want to do that model, they're probably going to have to increase their footprint, and that's going to be very costly. To increase the size of their stores, it's going to be a very costly addition to what they're already trying to do. Now, in the short term, I want to be clear about something, because the next round of next generation gaming consoles is going to be at the end of 2020. That's going to be the next Xbox, the next PlayStation. GameStop could easily have a huge surge in sales because of that. But in my opinion, it's going to be a short-term kind of phenomenon. After that, I don't see any of that growth being sustainable. So in the short term, I think this stock is going to be very volatile. I think maybe 1 week it jumps up 10%, another week it drops 10%. Again, keep in mind, this is a stock that is already down almost 85%. So all kinds of different things can happen with the stock in the short term. But in my opinion, it's kind of a gamble. It's risky. Which way it's going to go, I have no idea. It could potentially, GameStop as a company could potentially have some success within the next year going into 2020, and even, a little bit after that as well. So even a couple years, a few years. I don't think this company is just gonna go bankrupt right away, but down the line, and I'm a long-term investor, I like to think out 5 to 10 years, sometimes even decades. And with GameStop, I just don't see it as a good long-term investment. I'd much rather be investing in other companies like, I don't know, Google, Microsoft, Amazon, all kinds of better companies out there that are still growing at very high rates. And with GameStop, they're not even growing. So anyway, that's just kind of how I feel about GameStop. I don't mean to be too critical. I'm sorry if you're invested in GameStop and I'm being very negative. Again, I think they could have some success here in the short term. And if you're looking for some positive catalysts, I would say the next generation of Xbox and PlayStation, that could definitely give them a surge in sales. So maybe you have some good positive catalysts there, but over the long term, there's a lot of concerns for me. So anyway, that's just how I feel about it. I hope that you guys enjoyed the video. I'll have new videos coming out on the weekend, and I'll be making a video where I respond to your guys' comments and concerns and critiques and just everything you had to say about my portfolio, which you guys left a ton of comments. And by the way, a lot of those comments were extremely nice. So thank you for all the nice comments. And I'm going to try to respond to all of those in a video format. It's going to be a lot of fun. So I'll be kind of defending my portfolio and explaining why some of the decisions I made with my portfolio and stuff. So that'll be a fun video. It'll be on the weekend. If you haven't seen that video yet about my portfolio, I'll have it linked in the description in case you want to check it out. Anyway, I'll catch you guys in the next one. Thank you so much for watching. Take care. Hit the like button. Bye-bye.